One of the crucial details that OPEC omitted when it rolled over its production cuts for another year was how the group plans on winding down the agreement. When pressed by reporters, Saudi oil minister Khalid alFalih said that it was premature to talk about an exit strategy. Taking extraordinary measures to rescue the oil market without any idea on how to exit the intervention is not unlike what central banks have done over the past decade to juice the global economy. Intervening is easy, backing out is the tricky part. alFalih emphasized that any exit would be gradual, and he went to great lengths to point out the strong relationship between Saudi Arabia and Russia, and not addressing how to end the deal is critical to that. For now, the OPEC-Russia bromance continues. Jamie Webster, an OPECer at the Boston Consulting Group, told Bloomberg. However, if it took some arm-twisting to keep Russia on board for an extension this time around, it will be exceedingly difficult to extend again in a year, when the oil market is much tighter. As of now, OPEC and Russia don't see global inventories falling back into the 5-year average until the second half of 2018. Seasonally lower demand during winter months suggests that the destocking process will take a breather in the first quarter. Included in the November 30th announcement was the fact that all parties would revisit the agreement at the next OPEC meeting in June. That seems to be a formality since the meetings are always a time and place at which OPEC assesses the health of the oil market, but if the market tightens too much and prices rise significantly, Russia could push to end the agreement early. The flip side is that higher prices could spark another wave of shale drilling, which could keep a lid on prices and extend the rebalancing period. We'll just have to wait and see, and the oil market will be left in the dark on the exit strategy until June at least, unless something extraordinary happens before then. Goldman Sachs took a unique perspective, arguing that OPEC made it clear that it would act to stifle volatility, and that the oil markets are underappreciating that fact. According to this view, the exit strategy is somewhat of a misplaced question. alFalih's comments about how the group will remain agile and responsive to market conditions, combined with the fact that the overarching objective of the production cuts is to bring global inventories back down to the 5-year average, indicates that OPEC will remain data-dependent, which reduces the risk of both unexpected supply surprises and excess stock draws. Goldman analysts wrote in a November 30th research note, "This leads us to reiterate our view that long-dated implied volatility remains too rich in the face of growing certainty on break-evens and sources of future supply." Goldman said. Although an exact exit strategy was not formalized, today's announcement will further diffuse long-term supply uncertainty in our view, with the latest earnings from U.S. EPS and oil majors also confirming persistent declines in break-evens. In other words, nervy oil traders wondering about an exit strategy should just chill out. OPEC has everything under control. If the cuts tighten the market too much, OPEC has spare capacity sitting on the sidelines that it can call into action, while the extension of the cuts should take care of any shale comeback. There is time to settle the coming growth in shale output until the cuts end, while the OPEC extension is still not too aggressive, Goldman argued, reinforcing its volatility dampening effect. Meanwhile, the cap on Nigeria and Libya at 2017 production levels takes away any supply surprise from them. In short, the oil market is in good hands and the volatile trading isn't justified. Goldman even said that it assumes that similar production cut agreements, if not this one, will continue in the coming years even after production starts to rise, consistent with OPEC's modus operandi of the 1990s. By Nick Cunningham of oilprice.com, or top reads from oilprice.com. Page 2. The current rise in oil prices is more of a fear trade right now, driven by fear of what is going on in the Middle East, rather than a result of growing OPEC chatter or inventory reports. Todd Horwitz, chief strategist at BubbaTrading.com, told Bloomberg on Wednesday, the oil premiums are very narrow going out to the future, which means that this is more of a fear trade in the front month. Horwitz said on Bloomberg Markets, "To me, this is more of just another farce of what OPEC is trying to do, and trying to push these prices higher," the strategist noted. OPEC and its non-OPEC partners in the production cut deal are scheduled to meet in Vienna on November 30th to discuss the extension of their pact. While just a month ago a 9-month extension to the end of 2018 was the base case of all analysts, now there are growing voices that OPEC may delay the decision to early next year. The constant OPEC chatter and the return of some geopolitical risk premium in oil price with Saudi Arabia's purge, heightened Saudi intentions, and the Iraq-Kurdistan standoff, have pushed oil prices to their highest in 2 years over the past few weeks. According to Horwitz, however, the WTI price has little room to rise from its current price of around $58 per barrel, because U.S. shale will return stronger. There's a better chance that WTI prices will drop to the low $40s than they rise to the low $60s, Horwitz said. I would think that the rigs will be back in the fields and the shale producers will be pumping it out like crazy at these levels, Horwitz said. On Wednesday, Baker Hughes said that the number of oil and gas rigs in the United States rose again this week. The boost in the number of active oil rigs this week brings the total gained in November to 10, the first monthly gain since July. Oil and gas rigs combined were up by 14 in November, also the biggest increase seen since July, in a sign that drillers are once again eager to add rigs after scaling back in August. By Svetlana Paraskova for oilprice.com or top reads from oilprice.com.